So our next paper session is on informing mortgage market reform. Our speakers are Paul Willen, Ben Keyes, Ed Golding, and Karen Dynan. I think this will be particularly relevant and interesting given everything that's happening, and informed even a bit by the announcement that Senator Corker's about to retire. I think that could potentially even accelerate some mortgage market reform here in the U.S. So, Paul, we're kicking off with you.
Do I have the
Yeah, right here.
click?
Yep.
All set?
Yeah.
Okay, good afternoon, everyone. I just want to warn you, I haven't presented this in a while, so I may forget things. But this is joint work. This is on the price. The title of this paper has changed many, many times. And the last version of it is the time-varying price of financial intermediation in the mortgage market. And it's joint work with my colleague Andreas Fuster at the New York Fed and Stephanie Lowe, who was a PhD student at Harvard when we wrote this. And I don't know that I even need this slide. Everyone in this audience knows how important the mortgage market is. It's over the 14 years, 15 years of which our data mostly covers, there was $2.2 trillion a year in mortgage origination since 2008, which is mostly what we cover. 80% of that was securitized, and it's one of the main activities of the financial system is producing residential mortgages. So what we're going to do today, what we do in this paper, is to look at how much the financial sector charges households for the service, basically, of linking households with investors. And so investors have money to lend, and households need the money. And what the financial system here is doing is bringing them together. And what we do in the paper, most of it, is to develop a new methodology using a new data set, well, not so new by now, to measure the price of intermediation. And then what we're going to talk about is what we do in the paper is to measure two things. One of them is pass-through. So how do prices in the secondary market get passed through? So the prices that investors pay, how do those translate to the prices that effectively that borrowers get? And then, so we're going to talk about the pass-through, and then we'll talk about how the price of intermediation has changed over time, over our sample. And what you'll see is that, as a sort of preview, is that the pass-through is very high. It's a market in which changes in global financial markets are translated into prices that borrowers see literally within minutes or hours. But the other thing that we'll show you is that the price of this service, so at short horizons, the price, most of the service, in a sense, the price of the service is relatively stable. But over the long run, it moves around dramatically. Okay, so before I go, it's sort of important to understand what it is we're doing here. And a way to think about this is that we're basically, as I said, we're looking at the difference between what investors, the prices investors see and the prices borrowers see. And so the way that people typically look at this is to compare interest rates. So they compare the interest rate that borrowers pay, so the top line here is the Freddie Mac primary mortgage market rate. And then they compare it with some interest rate in financial markets. So this is a Fannie Mae interest rate, and this is the 10-year Treasury rate. And they look at that flow, and that we think of as, in a sense, the cost of intermediation. So this is the note rate, and this is some measure of cost of funds. But if we're thinking about the profitability of a transaction that the bank is doing, really what matters to the bank is the flow of payments over time. So this gap between, say, the Treasury and the mortgage rate, that's a flow. And the value of that to the intermediary is the present discounted value of that flow. So it's not the immediate, it's not the instantaneous flow, it's the present discounted value. And why is that a challenge? Well, it's a mortgage. Mortgages have uncertain payoffs. You don't know when they're going to pay off. In this case, they're insured, so you know that they're going to pay off. You just don't know when. And to value it using that flow, you don't just need this gap here. You need some way of valuing this random outcome. And that means you need a model. That gets complicated. And that's one reason not to do it that way. But the other reason not to do it that way is that that's not what financial intermediaries do. So you remember I mentioned 80% of the loans originated today are sold in the secondary market. So what lenders do is they don't make money on this flow. They make money on the difference between the price they pay the borrower for the loan and the price they receive when they sell that loan in the secondary market. So intermediation in the mortgage market, we have a borrower here on one side. We have an intermediary, say Wells Fargo, and then we have MBS investors. And the way the mortgage market works typically is that the borrower is connected here with a loan officer. And for a large fraction of the mortgage market, it used to be higher, but now it's probably about 40%, the loan officer is actually looking at a lot of different intermediaries, all of whom are offering the service, basically, of connecting that borrower with investors in the secondary market. And this is the primary market. That's the borrower going to talk to a loan officer. This could be a mortgage broker, or it could be a retail loan officer working for a bank, or for typically now it's what's called a correspondent lender. And there's a secondary market, and basically the intermediaries are linking the two, and they're charging a price for that service. And so how do the lenders think about this problem? They don't think about it this way with rates. The way the loan officer is seeing this problem is through two sets of prices. So this is the price effectively that the borrower sees through the lens of the loan officer. So when you call a loan officer, they look at a grid like this. And what does this grid have? So it has interest rates over here. So for example, if you're quoting a note rate, which would be an interest rate on the mortgage, that's the rate you would say my mortgage is at 4%. And then there's this number over here in this grid. And what that tells you is that for every $100 of principal, the bank will contribute another $2. So they'll pay $102 for every $100 of principal at 4%. And this thing has a lot of different names. It's called the service release premium, but most commonly it's known as the yield spread premium, and that's what we're going to refer to it as. And so effectively, you can think about a financial intermediary as buying a mortgage. If you think about a mortgage as a promise to pay money over time, the investor is paying $102.02. The investor here being the intermediary is paying $102.02 for every $100 of principal. Then the intermediary is going to turn around and look at a different grid, which is the grid of prices that Fannie Mae that are sold in the so-called TBA market, which is where they'll be able to sell the loan. And so the way the profit that a lender makes is the difference between how much they pay the borrower for the loan and how much they can sell the loan. That's price YSP. YSP is the price they're paying the borrower, and TBA is the price that they're selling the loan for. And that is how lenders make money. And then if we define the price of intermediation this way, then we don't need to worry about stochastic discount factors. We don't need to worry about prepayment forecasts. We don't need to worry about anything. We can just look at prices quoted in real time. So this, I pulled this yesterday, and actually I don't know, it says 10:15, but it doesn't say what day, which would be useful. Okay, And so what do we do in the paper? Basically, the big challenge is to get data on these yield spread premia. And so we use this new data set from a company called Optimal Blue. It used to be called Loan Sifter. Now it's called Optimal Blue. It's been taken over yet again, so who knows what the name will be if we ever publish the paper. But what this company does basically is just get, so these rate sheets here, it just pulls all the data from these rate sheets. And so what we have over time is a large sample of these offers, which are more or less binding offers from lenders for how much to pay. And then what we can do is we can compare those with prices in this TBA market. So the TBA market is a forward market. I think it's the second biggest bond market in the world. It's $100 billion worth of trade every day. And that is the market where you can sell a mortgage. And the market works very well for our purposes because it's a forward market. So basically what you can do is you can get a price right now to sell the loan into a pool at some date in the future. Okay, so in the paper, the first thing we do is to do some case studies. And we use these events of the announcement of various parts of quantitative easing. And there are two reasons why we do this. One is that it's of inherent interest because it asks the question, how much of the change in prices driven by Fed actions, how much of that was passed through to borrowers? But then it also gives you a window into how this market evolved over the time of the crisis. So the first thing you can see from this, so this is the TBA price. So this is the announcement of QE1. You can see the TBA price goes up by 1.5%, of 150 basis points. That's the TBA price. So what happened to this is the price that investors are paying. What happens to the price that borrowers receive? Well, in this case, it goes up by almost exactly as much. And so if you count the pass-through, it was almost 100% through here. Okay, so that's November of 2008. If we look in March of 2009, there's a similarly large increase in the secondary market price, again, because of a Fed announcement. But this time, you see very little, much a smaller response. The pass-through is somewhere on the order of 50%. So the Fed's actions are raising the price, in this case, by 100 basis points, but borrowers are only receiving about 50. Okay, so the point here, so there are a few things to notice here. One of them is to notice how closely these series track each other at high frequencies. That's the pass-through that I was talking about. And I'll show you in just a second. When you look at this systematically, this pass-through is very, very high. It's essentially close to 1. So that's one thing you notice here. Another thing you notice is that the pass-through here is much lower than the pass-through later. So what's the difference? One big difference is that the application volume before the announcement was much lower in 2008 than it was in 2009. So in 2009, in March of 2009, the way we see it, there isn't that much spare capacity in the market, whereas there was a lot of spare capacity in 2008. And I'll show you that holds up systematically. And the last thing to see in these pictures is that this gap is essentially 0 here. So the price of intermediation is 0 right before the announcement of QE1. And it's about 1 point in 2009. And that's actually part of another general pattern you see in the data, which is as our data goes along, this price of intermediation at low frequency is getting bigger and bigger. Okay, so the systematic evidence, this is a plot of the pass-through. You can see it's not just that the slope is 1. This stuff is pretty tightly around 1. We show in the paper, so the average pass-through is 0.92. If you regress the primary market price and the secondary market price, the average pass-through is about 0.92. There is a significant asymmetry. So decreases are fully passed on, and increases, the pass-through is considerably lower. It's around 0.87 after 2. It's 0.08 on the first day and 0.87 on the later on the second day. The other thing is that, as I already kind of alluded to, the pass-through is systematically higher when applications are lower, or systematically lower when applications are high. Okay, so that's the pass-through. And I already mentioned the other fact, and this is if we just take the average price of intermediation over time, the other big fact about this market is that this price has been growing a lot over the course of the 6-year period. And it is important to see this number here. So this number at the very beginning is low. But the historical levels this was not an abnormally low period here at the beginning. And so something has happened that's driven up the price that the financial system charges for this service. So what is it? What is it? Well, there are, we looked at a few things. And so let me go actually through the ones that, well, let me say the ones that didn't work. One of the ones that seemed was maybe interest rate volatility. And so interest rate volatility affects the hedging cost. So you might imagine that would explain why firms had raised the price of intermediation. So the lenders have to hold these loans between the time when they lock the loan to the borrower and actually deliver the loan to the investor. They have to hedge risk, interest rate risk, but you can see the interest rate risk is falling when the price is rising. The other story that a lot of people had was that it was an effect of concentration, and that the more the share of the top firms had grown, and those top firms had taken over a lot of the market, and they were exercising monopoly power. But again here, actually, it goes the wrong way. So the share of the top 4 firms in the, so this is all based on the Los Angeles market. The share of the top 4 firms here is actually declining over the course of this, and as the price of intermediation is going up. Okay, so the one that real estate, this is wages paid to people who work in real estate credit. So this would be workers in the mortgage market. And you can actually see here that there does seem to be some correlation. Which way the causality goes is hard to say. Whether it's the fact that there was an increase in the value of intermediation services somehow made the scarce skills in real estate more valuable, or whether something was happening to the supply of real estate of mortgage credit workers that was in turn driving up the price of intermediation. But the one that's really going to be strong here is loan applications. And you can see it here, even at very high frequencies, right? You see a jump here and a jump here, and even this little drop here is being picked up by the price. So this little drop in applications here is showing up down here in a drop in the price of intermediation. So again, we run a regression, and let me just show you, this is this specification here. If we just put in the number of loan applications from the Home Mortgage Disclosure Act data and a time trend, we get an R-squared here of 0.84. And this is true, the high R-squareds are true whether we do this in levels or in first differences. And you can just see this is the predicted, this red line here, is what the model predicts just using a time trend and the number of applications. The red line is what the model predicted, and basically most of the variation we see you can explain really through this time trend and applications. We get a little additional stuff here from this real estate payroll that has some correlation. And then the last column, we instrument for this using a spread that predicts applications, and actually the effect of application gets slightly stronger. Okay, so one other thing just about what our interpretation of this is. Our interpretation, I think, is that there are capacity constraints in providing the service of intermediation. And basically, that's a kind of simple explanation for why when application volume goes up, the price of the service of intermediating these loans also goes up. The sort of upward sloping marginal cost of producing intermediation. And you can see this. One other way to see this is to look just at the relationship between new loan applications and processing time. And basically, how does the lending industry deal with increases in loan applications? Well, one way is by raising the price, and the other way is by increasing the time it takes to process applications. Okay, so Karen, my discussant, said to me last night that in the paper we're very cautious and we don't say anything about policy. I should say, we don't say anything about welfare. And what's funny is that this slide here, it was always informally referred to us as our welfare calculations. But then when we finished the paper, we took the word welfare out because, welfare is not something economists have anything to say about. So what we did here, you could call these welfare calculations of a sort, is to sort of get some sense of what the impact on borrowers, some aggregate sense of what the impact of borrowers of these costs are. And so what we did was a series of experiments using our model, using the estimates from our data. And the starting point here is that over the course of these 6 years, our estimate is that households spent around a little less than $150 billion on the service of paying intermediaries to match them with investors in the secondary market. And so we did 2 experiments here. One of them was to remove the time trend. And if you just remove the time trend, that reduces the effect, the cost to borrowers to $55 billion. So it's about $100 billion in reduced costs. That's one effect. And the second thing is we asked the question, what if the market, when the number of applications went up, the price stayed at its baseline level from 2008? What if there were no effect of applications on the price? So what if there were no capacity constraints? Firms could costlessly or at fixed marginal cost intermediate an arbitrary number of loans, and that lowers the total cost over this period by about $50 billion. And so between those two, basically, you can get rid of most of the cost of that borrowers paid. We can also interpret this in terms of rates, because you remember what I said before, you do those grids, and on the grid, for every price, there's a corresponding interest rate. And so for any difference in prices, there's a corresponding difference in interest rates. And so what you can ask here is what would have happened to interest rates? And basically, our estimate here is that at the bottom, interest rates would have been somewhere between 40 and 50 basis points lower than they were, all else equal. Okay. So let me finally say, what is our interpretation of this? If you go back here, what is the policy implication here? Well, in the quantitative easing, the goal of it was to lower interest rates to borrowers by buying mortgages in the secondary market. And we have a system in which for borrowers to get lower interest rates, they need to refinance their mortgages. And so to refinance their mortgage, about 2/3 of this expense, by the way, was for refis. They need to go through this process of intermediation. And so because we have this fixed rate system, that's how. So in these periods when 2012, when we're doing all these refis, we're spending something like $40 billion that year just refinancing mortgages. And the welfare issue, the reason why we have to be careful about making any welfare statement here is obviously somebody, maybe people in this room, received that $40 billion. And so if you say it would have been better for welfare if people had adjustable rate mortgages and the transmission mechanism to borrowers of lower rates simply came through just directly through adjustments to their interest rate, that costs nothing. But of course, so that's good news for borrowers, but it's not great news for intermediaries. So in general, we side with the borrowers, right? So anyway, that is our policy implication. The other question here, which I'm not going to answer because I can't, is why it is that this price went up so much over time. And that's this time trend. And the simple answer to that people in the mortgage business insist is the answer is that it's regulation. And it's certainly sort of broadly consistent with what we see, but there's no kind of smoking gun here. There's no when a particular regulation was put in place, we see this time trend. The time trend is actually fairly stable throughout this period. Okay.
Great, thanks, Paul. Ben Keyes is our next speaker.
All right, well, thank you so much to the organizers for having me. I have an impossible task today, which is to tell you about this industry, the mortgage insurance market, and try to document some of the agency problems in this market in 15 minutes. So bear with me. I will do my absolute best. This is joint work with Neil Bhutta from the Fed. So the usual disclaimer applies, and this work really fits nicely into the themes that we've been hearing in terms of risk management, especially last night's discussion. The jumping off point for this project is really thinking about who bears risk in the mortgage market and some of the trade-offs between private actors and public actors. And so we have the GSEs and the FHA bearing risk on the public side. On the private side, we have banks, investors, borrowers, and insurers. And the popular view of the mortgage market is that we need to expose private capital to more risk, and that's going to discipline behavior in this market. And that's sort of broader than just mortgage markets. And basically all of the reforms on the table, and we'll hear more about this later, increase the role of private capital in the housing market. So the key that we're jumping off of here is, well, there was private capital in the housing market in the form of a lot of these players, but in particular private mortgage insurance, which were writing these insurance policies that protected whoever was the bearer of default risk, so paid for by the borrowers each month. The benefits go to the lender unless that loan is sold. If the loan is sold, then the benefits go to the investors, or in the case of the GSEs, because they're guaranteeing against default, they are the ones who are the beneficiaries of the insurance. And so the question for us today is, why didn't private mortgage insurance companies safeguard the GSEs, this protective layer of private capital? There are a lot of reasons why you would think they would actually be in really good position to do so. So first and foremost, they're in a first loss position. They're writing contracts on very high LTV loans. Once that equity is wiped out, the losses are going to the mortgage insurance companies, to that policy. So they should be very sensitive to fluctuations in the market. Next, these firms had decades of experience. This was not German pension funds investing in subprime Florida real estate. These were firms that had a lot of experience with fluctuations in the market and should have been very wary of changing lending standards, house price expectations, and so on. And then finally, they really stood in this gatekeeping position if they chose to do so. They had the ability to review loans prior to origination, and if they declined an insurance policy, then the GSEs would not be able to securitize that loan. They could raise the price on insurance or decline to insure certain mortgage contracts. So all these things put them in the position to be potentially disciplining in terms of risk in the market. And this was, I'll get to it in 1 second. I'll just skip to this one first. This was really their perceived responsibility in the market. So from the industry's trade group, their sort of annual report in 2008, 2009, they say mortgage insurers were designed to be review underwriters because they are in the first loss position. They are the second set of eyes looking at potential loans to check and see if it's safe for both the investor and the borrower. And everyone's favorite mortgage finance blog, the Calculated Risk blog, which got a lot of things right before almost anyone else did, they got this one wrong. They say mortgage insurance companies can smell change in the air just as much, if not more, than lenders can. Being on the hook for losses does tend to sharpen one's wits. So we think this is an important area to study. There's essentially no empirical papers studying this market, and I'll tell you about the exciting data that we're using on the universe of applications in this market. By the end of 2007, mortgage insurers had policies on over $800 billion of mortgage debt. The average coverage ratio was about 25%, so they had about $200 billion of exposure. And virtually all of the riskiest loans that Fannie and Freddie purchased required approval by the PMI companies. It required credit enhancement if they were going to lend for an LTV above 80%. So for all the folks who are putting down less than 20%, going through the GSEs, they need to have this mortgage insurance. So what we're going to show is that the opposite happened from this conventional wisdom, and that in late 2006 and especially 2007, PMI firms insured very high-risk loans. These were high LTV, low FICO, low documentation loans in the riskiest markets where prices were already falling or expected to fall based on their own market research. So we've been able to find some of their publicly available reports on their estimates of the cross-sectional heterogeneity in house prices. I'm going to show you that risk index actually positively correlates with their expansion in 2007 and with absolutely no change in their prices. They did this after the piggyback second lien market dried up. Another group of folks with informed market participants, private capital, also in a first loss position. After that market dried up, then they rushed in. In the wake of this, 3 of the 8 PMI firms failed, and the others massively rescinded policies. They rescinded about 25% of all policies that put in claims. So very quickly today, I'm going to tell you more about the institutional details and this data, and then walk you through what happened in this market during the housing boom and bust, and then try to talk about some of the complicated relationships in this market that may explain the patterns that we observe. So with a little bit of background, PMI is often required on loans when you put down less than 20%. And the main alternative for credit is this private second lien market. So when the piggyback market is active, instead of taking out mortgage insurance, you just take out a second lien, and that fills the equity gap. It's mandated for all high LTV GSE-backed loans. They were able to change the GSE charters in the 1970s to require this credit enhancement. And in 2007, over 90% of the mortgage insurers' business was through the GSEs. The market consisted of 8 firms who were basically doing monoline business. So all the premiums that were coming in were going towards the losses in this market. They couldn't cross-subsidize across different products. Here's just a little schematic to give you a sense of how the market worked. So when a borrower goes to take out a loan, it's not the borrower who chooses which PMI firm to go with. You don't go around and shop for mortgage insurance. The lender decides who is going to provide the mortgage insurance policy. So the borrower pays the premium each month to the PMI firm, but it's the lender who's made this choice of which firm to go to. Once the loan is sold, then the insurance policy is now protecting the GSEs. And these arrows are in red because we think they might be kind of problematic. So the PMI firms are supposed to keep an eye on the GSEs when we think about kind of asymmetric information, moral hazard issues. But the GSEs regulate the PMI companies because they have a set of eligibility rules that you have to be on an approved insurer in order to participate in this market. So there's a really tense dynamic there where you have these very large players in the market in Fannie and Freddie who can dictate the terms of the relationship. So this picture is sort of a joke. The idea here is that the pricing never changed in this market from 1996 to 2008. And so these insurers were all basically offering the same prices, all 8 firms. That's consistent with a market that's perfectly competitive. It's also consistent with a market that's perfectly collusive, right? Here's the 3 most common contracts that you observe. And they're all, for all the data points that we've been able to find back to 1996, they were all priced exactly the same. So they're not making any changes to their premiums. They're not responding when automated underwriting drives down their application costs, when they're faced with aggressive competition from the second lien market, And this is unique for an insurance market, right, to face competition from a spot market. And they don't change their prices when they receive tax equalization relative to second liens in 2007 either. So they're just not responsive on the price dimension at all. What are they competing on? We'll talk more about that in a minute. The data that we use for this market is very similar to the HMDA data, which I'm assuming most people in the room know about. It's actually collected by the same federal agency. And for 20 years, from 1993 to 2013, they collected essentially all the same fields that HMDA collects about every mortgage insurance application. And this data set hasn't really been used to study the housing boom years at all. We also do a merge with the HMDA data and the PMI data. Those data sets are about applications. They don't follow the loans and the performance. So to supplement this, we use the LPS McDash data to look at how these loans perform over time. So just to set the stage for how the PMI companies responded during the housing boom, if we go back to the period of 04 to 06, this is the peak years of piggyback lending. Very generous financing, very generous terms for second liens. They also have a tax advantage from the mortgage interest deduction, so they're much cheaper relative to most of the PMI contracts that are out there. So the PMI companies on this loan level insurance are losing market share, and they're losing it pretty dramatically. So these firms are shrinking over this time period, and their trade association is sounding the alarm about all the risky lending that's going on. Now, partly that's just talking their own book. They'd like to have more business, but they're also identifying some of the key drivers of subsequent foreclosures in terms of high LTV lending. By the end of 2006, we're in a period where it's getting much clearer that there's going to be a downturn in housing markets and that there's going to be heterogeneity in that downturn. That's going to be much larger in the sand states in particular. So by the end of 2006, prices in 88% of sand state MSAs were already falling. And here's what this market looks like up until the end of 2006. So the blue line is the piggyback share in the market, and that rises from about 3% to over 20% of all purchase loans have a piggyback loan attached to them. And the PMI share, the red line, falls from about 25% down to 15%. And the patterns are even more dramatic in the sand states. So here's the insurers sounding the alarm. In August of 2006, they say, we're deeply concerned about the potential contagion effect from poorly underwritten mortgages. There's a fear of widespread foreclosures. And each quarter, they're publishing this report that goes out to the industry. And so these are publicly available, and we've been able to dig up many of them off the web. This is from one of the companies, which is called the PMI company, which is confusing. But the other firms are reading this report as well and keeping an eye on it and running their own kind of similar calculations. And they generate this risk index. These are the MSAs that we view as the riskiest. So in the summer of 2006, based on spring 2006 data, they say that San Diego has a 59.9% chance of declining house prices over the next 2 years, and that 13 cities are more likely than not to have a decline in house prices over the next 2 years. So we don't know exactly how this mapped into losses, right? How house prices map to default, mapping into loss given default. But what we show here is that this risk score was ex post accurate. So the x-axis here are those index values that I showed you from that table. And the y-axis is the change from June 2006 to the trough of house prices. So it correlates pretty well, and it looks like they were on the right track. And we're setting a pretty tough standard here using the June 2006 version, so they get increasingly accurate as you go quarter by quarter into 2007. The very next issue in fall of 2006 of this report, the first sentence says, this is the chief risk officer of PMI company, there's no longer any doubt that the housing market is cooling. Right? So this is their fall 2006 report. And here's the takeaway from the paper. Here's what happens. This is mid 2006, and this is 2007. This is the growth rate in issuance. So they're shrinking in 05 and 06. It's less than 0. And then it shoots up to over 50% growth in 2007. Even stronger than this, in a slide that I have taken out in the interest of time, is that this growth is even sharper in the sand states. So exactly those markets that they're showing to be the highest risk. Here's what happens in 2007. the piggyback market collapses starting in mid to late 2007, and the PMI market spikes such that in the third quarter and fourth quarter of 2007, about 35% of all purchase loans have a PMI contract attached. This is the key takeaway from the paper. If you're going to remember one slide or take a single picture, this is the one to get. This shows that the risk index from 2006, in the summer of 2006, is positively correlated with their growth. So this is, they're growing more, they're writing more insurance policies in the markets that their own reports are suggesting are riskier, with no change in prices. They're growing more in the places where prices are falling or are beginning to fall. So this is just a plot of the second derivative. You can do this a lot of different ways. These are ex-ante riskier markets that they're moving into with basically no change in pricing. So we wondered, well, are they just shifting regional risk, house price risk, for individual characteristics? Maybe they're writing policies on safer contracts and safer borrowers, and that's not what's happening. So from 2005 to 2007, one of the firms increases their share of LTVs above 97% from 14% to 25%. So you need only a 3% downturn in house prices to wipe out the equity, right? They're doing more Alt-A, which are lower documentation, more interest only and larger loans over this period. So they're not shifting away into safer contracts. So what happens? Well, these firms collapse. Here's the Radian share price, and here's the Genworth share price, two of the big firms. I have pictures that show this, that actually the growth in late 2007 is, a lot of that's coming after the share prices fall, right? So from a kind of traditional risk shifting standpoint, it looks like they're doing a lot of this after their prices are already falling. Our back of the envelope suggests that the industry lost over 90% of its market value. I mentioned before, 3 of the firms failed, were unable to pay out all of their claims. The others rescinded policies very aggressively in order to stay in business. So we have this set of facts that there's a huge increase in issuance in 2007, disproportionately in high-risk markets that they knew to be higher risk, towards higher risk contract, with no regional pricing, no increase in premiums, and the market essentially failed to make good on its promises. So again, we come back to this dynamic of trying to understand some of the agency problems in this market. So first, I want to talk about the relationship with lenders. So it's complicated. It's a complicated relationship between these firms and lenders because the lenders can have them compete against one another for their business. And this is just showing that of the top 100 mortgage lenders, most of them are working with 6, 7, or all 8 of those mortgage insurance companies in a given year. So they're competing for this business, and they're not competing on price, but they're trying to compete for access to these big lenders. So what can they compete on? Well, potentially one of the things they can compete on is speed. So they want you to play ball, and they want you to originate these loans quickly and move them out the door. So in the early 1990s, this review process of the MI companies took 7 to 10 days, right? You'd mail all the paperwork to Milwaukee, someone would check it all carefully, and you'd ship it back. By 2007, their stated goal was a decision in 2 or 3 minutes. And the general counsel of one of these firms said, if it's good for them, it's good for us, which is, from a moral hazard standpoint, very problematic. They did this through delegated underwriting, where they would allow lenders to approve mortgages on their behalf, but then they reserved a right to basically review these ex post, to potentially rescind policies later. And in some cases, they just ceded their underwriting outright to the GSEs. So here's a quote from MGIC. Beginning in 2000, loans approved by DU or LP, which are the automated underwriting systems of Fannie and Freddie, were automatically approved for MGIC mortgage insurance, even if the loans were outside of MGIC's published guidelines. This was about 25% of the time when they were approving loans in 2007 that went through these systems, the loans were actually outside of the published guidelines. So here's the rise in delegated underwriting over this time period that we've collected from the 10Ks of these various firms. And you see a big increase in this use of delegated underwriting. So they're not review underwriters ex ante over this time period. Thinking about this link to the GSEs and market power, what you see is that all 8 firms in this market are essentially doing the exact same thing. So we thought about all these stories about, well, do they have different incentives for their CEOs? Do they have different risk management? Different types of relationships with shareholders. Some of these firms, AIG here, this is United, which is a subsidiary of AIG. Do they behave differently? The answer is no. None of those things explain any of the patterns that we observe. They're all moving in lockstep, which is, again, suggestive of following broader sort of market forces related to the GSEs. So I don't know if this has been really cleanly documented before, but this is just showing that the GSEs took on significantly greater risk over this time period in 06 and 07, especially for low FICO, high LTV. So the green line here shows a 5-fold increase in low FICO, high LTV loans from 2005 to 2007. And the only way they're doing those loans, those high LTV loans, is with the approval of the mortgage insurers. And the GSEs and the PMI firms are growing in lockstep over this period. So how does the industry respond? Well, they start by reviewing these much more carefully. Denial rates shoot up from about 2% to about 13%. And they also begin denying claims ex post. 20 to 25% of all claims were denied in 2008 and 2009. And our back of the envelope suggests that if rescission rates had stayed at historical levels of 3 to 5%, all 8 of the firms would have been wiped out. So just to wrap up, I know that was a really fast pass through a market that some of you have probably never heard about before. Some of you have. But hopefully I gave you a sense of why it's important that we understand this market if we care about people who can't put 20% down for a home. This really is important for low wealth households. I think the conventional wisdom about the PMI firms being more astute than the rest of the market was absolutely wrong, and I don't think that view has been fully revised, even among policy circles. They place very large bets on high-risk borrowers, high-risk contracts, and high-risk markets. And I think overall we provide some additional evidence that the GSEs dictate not just the rules, but also market participant behavior in the mortgage market. I'll stop there. Thanks so much.
So our next presenter, thanks, Ben. Our next presenter is Ed Golding, who's going to try to get us back on track from a schedule perspective.
Oh, the pressure's on. Jane Dokko, my co-author, was supposed to be presenting. She had an unanticipated first birthday for her daughter, and it's hard to forecast some of these things. And she wisely chose to stay with her family on that. But all errors are mine, and all insights are hers. I don't want it to be on this slide. There we go. The motivation of this paper, Jane and I, and a few of you in the room, were in many discussions about housing finance reform. In the old executive office building and other locations, and up on Congress. And the one thing that those of us that were sort of trained as economists at the end would always try to go back to first principles, and whether it's sort of, structure, conduct, performance, we were sort of looking for some economics to guide us. There's a lot of politics that guide you, a lot of folklore, and some of these excellent papers just heard about try to strip down some of that folklore into empirical observations. But there was very little that you could take out of your industrial organization class and decide this is the right way of organizing the secondary mortgage market. So we decided we would at least attempt to go down that road. I'll let you judge how successfully. Much of it's based on sort of expert judgment and intuition, but what we have done is try to make some of it explicit on how we would evaluate the alternative ways of organizing the secondary market. And then we also go from there to trying to decide, efficiency isn't the only measure, you also worry about equity. And one of the conclusions that we'll take from this, and we'll show it, is that the equity considerations really are not independent of your choice of structure. So it's not as if you can deal with equity issues at the end and just say, oh, there's an add-on that we can do on that. So the first thing that we did in this journey was trying to be explicit on what the alternative structures are. And there are many different proposals that have been out there. And I'm not going to go through each row today for the sake of time, But we basically looked at 4 different ways of organizing the secondary mortgage market. The first one is sort of an insurance model. And for that, I think of sort of the way FHA provides. They don't purchase the mortgage, they just insure it, and then it goes into a security like a Ginnie Mae. And some of the proposals have been to try to work off of that insurance model. Second one is what we call purchase model. We can also think of it as the GSE model. As was talked about on some of the papers today, the GSEs actually purchase and own the mortgages on that. And so a lot of the principal agent issues are resolved because they are the, in fact, owner of the mortgage on how they do that. The third model, which we sort of saw, was the private label, and that's the structured financing of mortgage credit risk. And the fourth model that we sort of was discredited, but maybe making a little bit of a comeback, was the portfolio model. Why not just have the savings and loan basically decide what mortgages to make and then have them also fund it? Think of the portfolio model as the most vertically integrated model out there on that. There's a fifth model, which I didn't put. Maybe it's because I ran out of room. Maybe it's because it's similar to the healthcare debate that no one really wants to, thinks it's feasible. You could have just a single payer government model where all the insurance is done through literally through the government. I left that one off. That's for another discussion. And we tried to be explicit in how each of these structures fund mortgages, whether they have a government guarantee, how they make the underwriting decision. I think you just heard, sort of how MIs do or don't make underwriting decisions, how they price the credit risk, and then I think as importantly, how they service the non-performing loans. So these are sort of the main functions that have to be provided no matter how you organize the market. So we then went from making the structures explicit to how are we going to evaluate the performance based on these different structures. And we chose basically 6 different, sort of I would think of as efficiency measures. One that there's been a lot of focus on, which is the cost of funding. How expensive is it to fund the mortgage on that? Do you have a liquid TBA market with very low cost funds? Do you have deposits? Do you have a senior sub structure? Each of those have different implications for the cost of funding. I think as importantly, we often don't focus on is just what is the cost of operating these institutions. I worked at FHA for several years, and I knew FHA was inefficient and the like, but it actually ran at 1/10 the cost of what the GSEs ran at. And you have to have a lot of efficiencies in other dimensions. If the GSEs right now, I think, are spending roughly $5 billion a year in overhead in G&A. Every CEO comes in and says they're going to cut it in half, and then 3 years later, it's always 10% higher. So the cost of running these entities, I think, are an important measure of efficiency. The third criterion that we have is market power. Does price equal marginal cost? And I think Paul had some discussions about how that started to, the price and marginal cost perhaps were getting worse in terms of the wedge between the two of them. The fourth was what about information costs, moral hazard, adverse selection? How do each of these structures address those issues that we know are important in the mortgage market? The fifth one, which I think is more along the lines of dynamic efficiency and growth rates, and I was sort of particularly interested in some of the discussions about China, where you see a lot of growth and a lot of innovation. We sometimes forget that static efficiency is, in the long run, not as important as dynamic efficiency. And I'm struck by the fact that the cost of originating a mortgage now is higher than it was in 1990 and takes longer. I think some of that, and it's not all regulation, as was pointed out, some of that has to do with how we organize the market. And then the sixth one is macro stability. So for the sake of, Jane and I had lots of discussions. These are sort of expert judgments. We try to go back to first principles. How many firms would you expect in each of these structures? You might expect portfolios, savings and loans to have a lot more than the GSE model, the insurance model in between. If you think you know endogenously how many firms are going to come out of these structures, you can start to rank how efficient they are based on these different criteria. And so, for example, on the innovation one, it's footnoted there. We just assumed a very simple U-shaped. We went back to the literature, and again, how much you believe it, but it was expert judgment. Monopolies and perfect competition don't tend to innovate historically as quickly as if you have, just several firms competing. It's out there. You can, freely disagree with it. What we are basically pointing out is that you have to, you should have a view on each of these different measures of efficiency. And then what we did was, with the help of Excel, did a spider chart on how these different models did on each of these six different criteria. And one thing that you notice on this, and each hexagon represents a different model. So for example, the 1 and 4 means it's better, and the 1 is a worse score. You would like that one of the models sort of encompassed all the others, were outside all the others. And you basically see that you do not have any one model that dominates the other models in our ranking. And so what came up on that was the importance of, you really have to have weights. If you're going to choose between these different structures, how important is innovation, how important is funding costs, and the like. And it's important to have different weights. I look at this, and again, partly this is my bias from where I've been much of my career. But if you look just at it, you would look at PLS as not doing as well. That's sort of the white inside. And that the GSE purchase model actually does better on many of the criteria there. But the important thing is that our conclusion is that there's no one clear right answer to this. And then we started, in the discussions of, well, okay, that's great, that's efficiency, but what about the equity concerns? And you hear a lot when you, especially among the Democrats, when we were debating the different legislation a couple of years ago, really concerned about economic outcomes. We're talking about financing people's houses. We care as a society about home ownership rates and availability of credit. We're seeing today a lot of credit rationing taking place and people not being able to get mortgages if they don't fit into certain boxes. What about the equity trade-offs? Certain parts of these markets may not have as useful outcomes as others. So for example, competition, we believe will drive you more to risk-based pricing and less of a cross-subsidy in the model. The other thing about competition is that there are fewer rents to be had. This is a market where, not surprisingly, there are a lot of rents to be distributed, a lot of profits, and a lot of the goals and housing goals were really trying to redistribute the GSE rents because they got a subsidy that didn't get competed away. How do you target those rents to certain populations on that? So it's one of those things where you cannot just say, here are the efficiency goals I want, and then think about equity separately. The other thing is, very often as economists, we say, well, let's just deal with the equity issues through a tax subsidy scheme on that. And I think the one thing that we, as we thought through this, the ability to do a tax subsidy scheme within any one of these structures is very much limited by how much competition there is, especially from non-covered entities. So, as whether it's shadow banking or the residual banking portfolio, there's only so much that you can extract from that on that. Last point here, and this is one I sort of alluded to a moment ago, there's a lot of credit rationing in this market today. I think, the primary reason really isn't sort of the adverse selection that you would think of in some insurance markets. I think it really is risk aversion because you have limited GS, you have two GSEs. And I think in some sense there, whether you call it profit satisficing or not wanting to jeopardize the charter, the Freddie Mac's former chief economist used to describe Freddie Mac as having a license to steal today and a license to steal tomorrow, and you had to balance how much risk you wanted to take. You had very, interesting behaviors out there of not, why expand the market if you're already making a lot of money on that. And I think you have a lot of credit rationing under the GSE model, something to worry about. Traditionally, when we look at equity issues, the other thing to point out is that each of these models seems to have its own way of addressing equity. When you do an insurance model, it tends not to have housing goals, but it tends to have sort of assigned risk pools on that. The GSEs sort of experimented with housing goals that have been widely criticized and duty to serve. PLS market, as it was originally started, actually expanded credit, and then we know what happened there, portfolios, CRAs. So I think, what I want, let me just go to the concluding thoughts here. As we think about housing finance reform, I think it's important to recognize that there's no one clear market model, way of organizing that dominates, that you need weights. The political process is one way of gathering those weights out there. I'm going to go back to, we probably should focus more on innovation than we have historically on how to organize these markets, and I would even encourage policymakers when they're looking at structuring things to be very explicit on those provisions that they think will facilitate innovation. Equity is intertwined with this. It's not just an add-on. And the other thing, of course, is that while it's often better to do housing policy not just on the secondary mortgage market, but to open it up to issues of tax code and the like that will be happening. The one factor that we didn't talk about, which actually may really dominate the whole discussion, are transition costs. How costly is it to reorganize the market and start over? Do you really have a choice, or is it just too hard once you have $5 trillion of securities out there? The transition is too difficult. And I think that is also a factor that as we start to think through this, we need to expand on how serious are the transition costs on that. So let me leave it at that and turn it over to Karen.
Great. Thanks, Ed. So our discussant, Karen Dynan.
Thank you. Okay, so it's really not uncommon to start your remarks by thanking the organizers, and I certainly want to do that. But I want to thank them not only for giving me the opportunity to speak, I really want to thank them for their choice of papers, because these were really 3 excellent papers. I really like them all, and I learned a lot reading them. And I think they're all important in different ways, as I'll describe. Before I even go there, let me give you some context to kind of set the stage for my discussion. It's been 9 years and 22 days since Fannie and Freddie were placed into conservatorship by the FHFA. This was never meant to be a permanent situation. This is actually a quote from Secretary Paulson in January of 2009. It's clear to all that conservatorship is a temporary form. And that sentiment has been echoed kind of repeatedly over the years by various people at Treasury and within the government generally. Housing finance reform has been called out many times as a priority by key policymakers. If you just go and you Google housing finance reform and priority, you just get page after page after page of just people either writing that that's their opinion, but more importantly, just like quotes from just key people, either in the administration or in Congress. I think the most promising thing that's happened over this period is that there was a bipartisan reform bill that made it through committee in the Senate in 2014. So in fact, that's how I got to know Ed and Jane, as we were all working together in the administration, providing what we called technical assistance to the Hill as they were doing that. So it made it through committee, but it did not get a vote on the Senate floor, so it died thereafter. So really just conservatorship continues. So I'm going to give you my opinion about why we haven't seen reform yet. I'm going to do this with some humility because the next panel actually consists of a bunch of kind of heavy hitters in terms of policymaking in the reform area. So I'm sure they have their own opinions. But it's not because of a lack of proposals. So 6.5 years ago, in early 2011, we actually had a conference when I was at Brookings on housing finance reform, and I just remember at the time that there were just like 10 key proposals, and we had kind of this table of the big 10, and we were talking about their differences, and there have just been so many proposals even just since then. I think like if you ask people now what the big proposals were, they wouldn't even kind of name these proposals because there's just so many of them out there. So that's not why we've seen a lack of reform. I think there are various reasons, and I think they start with political obstacles. So any effort that basically has the term reform associated with it basically will have kind of winners and losers. And you will see kind of the losers, of course, will fight against it. I think we're seeing that play out with tax reform right now. So I think that's why we're not likely to get truly comprehensive tax reform. We're going to get tax cuts because everyone's a winner. So they're political obstacles. I think the other thing is that housing finance reform, it's just between the financial engineering and the institutional details, it's just a really complex topic. It's hard to understand, and I just remember this when we were working on it in 2014. Like we were trying to kind of explain it to our smart colleagues who weren't kind of in the inner circle. Why were we arguing to make this big change in the system? And it was hard to explain it to them, let alone what a politician has to do, which is they have to explain it to the average voter why we're going to make this huge change. So I think that's a factor. And then there really are substantive disagreements. There are all these things that people care about. They want to know what's going to happen to cost. They want to know what's going to happen to access. They want to know what's going to happen to systemic risk. And there's just really a lack of evidence as to kind of how these things would change under different proposals. And I also think, there are, and this is something Ed was talking about, there are different goals different people might be trying to achieve different goals, and there are just questions as to how you prioritize these goals. So all these things kind of just make for this very messy policy process that I think has stood in the way of actually achieving housing finance reform. So with that set up, now let me just talk about the contributions of these individual papers. So let me start with Paul's paper. So this is just a very impressive paper. I suggest that everyone reads it. I mean, it's just a very kind of thoughtful, kind of intensive exploration of this new data set that's looking at the cost of financial intermediation, the cost of originating, underwriting, servicing, and possibly profits. So it does that and has some interesting findings. So they find the degree of pass-through from secondary market to the primary market is large and it's timely. I think kind of you're watching this data closely, maybe the timely part isn't kind of the most surprising thing, but if you're thinking about kind of how it works in terms of pass-through with other forms of consumer credit, it's actually quite striking that they find this very, very kind of timely within the day pass-through. But it varies, the pass-through varies with demand. and they tie it to capacity constraints. That's an interesting result. It has implications, of course, for affordability, but it's also having important implications for monetary policy, as Paul points out. And they also find this uptrend in intermediation costs over time. That's going to have important implications for affordability. And then I will say it is true that I was ribbing Paul last night about this sentence from their paper, which is we're not making any welfare statements. I think I was saying, it's clear that this is, a paper that you're trying to get into a journal because that's what you write when you're trying to get a paper into a journal. But actually, I think I actually put it on the slide because I actually think it's a really good caveat. And so Paul took us through some of the kind of welfare considerations, but you have to understand this is complicated. To some degree, we're talking about transfers here, but even if you're talking about kind of a rise in the cost of intermediation over time, if you think some of that has to do with more regulation, those regulations have welfare effects. They make the system safer, for example. So I thought it was an important caveat. Then turning to Neil and Ben's paper, I love this paper. It looks at this really important mortgage sub-industry, PMI, that has received almost no attention in the academic literature with a data set that has as yet, before these guys hadn't been tapped much. As they say these days, this is pretty huge. And then they have these really striking findings, which is that the PMI companies, they had the tools and they had the incentives to basically impose constraints on GSE lending when the risks were increasing. But what did happen was that PMI actually surged as the troubles in the housing market started to ramp up. So it's just a kind of really striking finding. The last part of the paper is kind of more speculative, but they do kind of make a convincing case that a key factor seems to have been the relationship between these companies and the GSEs. And I think just there's a very kind of important lesson here for when it comes to reform, that the institutional details of the system really, really matter. Okay, from there, let me talk about Jane and Ed's paper. So, the starting point for the paper is that they're recognizing that all these different proposals that I mentioned earlier basically are associated with different secondary market structures. And with that in mind, they create this really kind of interesting matrix showing how different secondary market structures perform with regard to different possible goals of reform. And it is an inherently stylized exercise. And I think Ed made that clear. The proposals don't actually fit neatly into the columns. And many of the rankings, as Ed was saying, they're informed guesses based on kind of limited evidence. And I'll make the point that neither of these things are your fault. And I will say, anyone who has sat at the policymaking table, as Ed and Jane and I did, can tell you that even with these limitations, these exercises are immensely useful. It's just part of the policymaking process that you're often dealing in. You're operating in this kind of second best, or sometimes it's like an nth best world. And this paper is really doing some important things. So first of all, they're compiling and distilling. And I italicized those words because I think distilling is an important part of kind of organizing this complicated information. But they're compiling and distilling a lot of information, both from research and from the author's own institutional expertise. And I should say in that regard, having worked with both of them, they have vast institutional expertise. I think like Ed's brain basically should be treated as like a national asset after running the FHA. So they do that, but then on top of that, they're kind of moving the debate towards thinking about trade-offs. I think most of the people in this room are probably pretty good about thinking about trade-offs, but and I think that's true for most of the people in the policy process, but when you're talking about something really complicated, it doesn't always happen that way. They point out that the weights you assign to different goals make a big difference in which plan dominates. And I should say the other thing that I liked about the paper is that they heighten focus on features, for example, the system's ability to mitigate shocks that probably haven't gotten enough attention in the literature. So I think these three papers altogether, I think they not only inform the mortgage finance reform, I think they actually advance the debate. I think clearly the first two papers, they're filling in some of this missing evidence that is an obstacle. And then I think Jane and Ed's paper, they basically help to organize what we know. They simplify the conversation. They provide this concrete framework for comparing options. And I think together those things will all make the policy process less messy. Now, all this said, let me just spend my last few minutes on where we should go next with these papers. I think one thing, and as I'm kind of preparing the discussion, I'm thinking, well, how do we put all these papers together and kind of help them make each other better? And I think there's obvious scope for Paul's paper and Ben's paper to help inform kind of the boxes in Jane and Ed's paper. So, for example, Paul's work, it's inherently kind of backward looking because they're looking at what did happen under the system that we had at the time. But I do wonder if there's more to say kind of in a forward sense of whether their data can tell us anything about how these different costs would vary under different market structures. And then with Ben's paper, I hope they will do kind of more digging into exactly what it was about the relationship between the PMI companies and the GSEs that kind of led to these problems. But I think as they're doing that, I think they'll come out with views that help inform kind of the rows on market power and information costs. So I think that's one obvious thing. I will say, I think the paper by Ben actually raises a further question about the Dokko-Golding framework. And that is, we've got these rows of these that are corresponding to different goals. But there is this goal that is not in the rows, which is how do you deal with the goal of not causing another global financial crisis? Which of these structures is going to be least likely to lead us down that road, which is naturally a very important goal. So this is my last slide. I think the answers are, I think it's a really important thing to be thinking about. I think the answer is actually unclear. So first of all, I should say, maybe you just say that's not an efficiency consideration, but you're putting macro stability in the last row, so I think it kind of gets grouped in your table. You could just say, this is like a simple exercise, and we're just assuming that, these structures, they're going to have the best possible design. I think you could do that. I think we all understand that's not a really realistic outcome, that they're going to end up with just the optimal design. And I think the costs of being wrong are really large. You could incorporate these concerns into the macro stability rule. I think you could do that. I actually think it's probably pretty hard to do that because it's pretty hard to do it in an abstract way without knowing the details of the arrangement. And I also would say you don't want to distract from the point that some of these structures are better than others once you're in a crisis. And I think that that's one point that you're making that's actually a really important point, which is that if you have government involvement, that's actually going to make you better off once you're in a crisis. So my last suggestion, which I think at this point is my favorite, which is just to try to think about whether there are rows to add or another dimension of the paper to add, where you're talking about kind of scope for regulatory capture, transparency, safeguards against safeguards against incentives to take excessive risk, but things like that. So yeah. So that's it. Again, thank you to the conference organizers for asking me to read and talk about these 3 papers.
Great. Thank you, Karen. All right, so we have some time for questions. We started a little late, so we're going to reclaim a couple of minutes. But do we have some questions? Yeah, Jonathan.
This is actually for Ben. So that was fascinating, and what it sounded to me was almost like informal vertical integration. So in order to have us do business with you, you need to set the price that we all agree on. And if the industry really is highly competitive, as you think like it might be, it's hard to have any price differentiation there. And so it's vertically integrated. The GSEs tell them what rate to charge, and then if you do not do as we say, we won't use you, and that's your only market, and you basically are done. And so as long as there's positive charter value left, again, you're willing to write contracts that lose money if you're being told to do that. And so in some sense, it's not a canary in the coal mine. It's a paid miner.
Yeah, there's one more layer to that, which in the integration side with the lenders as well. So I didn't have time to go into this, but one of the dimensions that they competed on was the reinsurance business. And so there's a whole other layer of this market. You have to understand the rules and regulations of the state of Vermont. But there was another layer of vertical integration which said, if you kind of play ball with us for this insurance, then we'll reinsure some of the mortgage insurance risk through the captive subsidiaries of the lenders. And this is the CFPB went after them on this dimension. So you have this integration across not just the GSEs and the insurers, but also the lenders and the insurers, which just adds another layer of complexity.
So is that, in that light, the GSEs selling off the systemic risk doesn't sound like a bad outcome relative to what we had before.
Yes, but they're not. They would, but that's still allowing them to make those make those additional marginal loans, right? So that's the trade-off, I think.
Yeah, in the back.
When you think about the financial intermediation, you mentioned capacity constraint. Two quick questions. One, did you take a look at the kind of the employment statistics for the real estate market and real estate lenders? And two, is there any other way to kind of measure capacity constraint in the kind of the real estate mortgage market right now?
So this question is for me. So yes, we did. And I'm going to say it's in the paper, but I'm not 100% sure anymore. But we definitely looked at that, and definitely employment went up, and in fact it went up more or less in step with it's very tied to volume too. I mean, again, it's hard to know, but you'd say that the marginal people you're bringing in, I mean, we know this about the mortgage market. We know that they can bring in kind of, so for example, mortgage brokers were always the marginal, you didn't have to hire people. You could just do more wholesale loans. So that's always been there. That was much more difficult to do in this period. That may have smoothed things out a lot more back in the before the crisis, but the decline of the wholesale market, so the decline of the broker market made that much more more difficult. You actually had to hire people. So as far as the capacity, if there are better ways to measure capacity, yeah, and there's some. I mean, one of the things we're always saying is it is always surprising to people is, I mean, there are thousands of mortgage companies out there, and it's a remarkably competitive. If that isn't a competitive market, it's hard to know why we even bother teaching it, because there are, once you get out, there are a few big firms, but they don't account for that much of the market. And once you get out of that, it's rare to have a firm with more than 1% of the market, even in a sub-market. So it's relatively easy to set up. It's relatively easy to expand your footprint. So it's a little hard to see why it's so much of an issue, but apparently it is.
Can I add just very quickly, though? Credit was very tight in the sense that borrowers in the heyday could get multiple offers within the hour. They were worried about getting it to a yes because of the tightness of credit. So I think the search costs on the consumer side went up during this period. So it's a different hypothesis to explain sort of why margins may have gone up. Consumers would not search as much, more recently. And I think you're absolutely right. It was because the sort of broker model was discredited. More people were going to the retail model, and that is harder to expand. So I think both of those would sort of explain the trend that you pointed out.
All right. Ben has a question.
In measuring the cost of intermediation, don't you have to take into account that the frictions of the refinancing are embedded in the valuation of the mortgage and the mortgage option, and that if you made if the refinancing costs were not there through the frictions, the cost to all the other mortgage people who are borrowing would have to increase to take into account that there's the option they're writing or the option that they're receiving is much more valuable. And wouldn't you have to net that out?
Yeah, that's going to be netted out in the TBA price. Right, so the TBA price, what you're saying is the TBA price is going to go down when, in fact, it's exactly why we need to do it this way, which is that's exactly what's happening, which is, in other words, if you know that, if for example, you knew that it was going to become much easier to refinance in the future, right, then the TBA price is going to reflect that. So for a given note rate, you know that that loan, for example, is going to be refinancing much, well, if rates go down, it's much more likely to refinance. That's going to show up, in the price. That's where it's going to show up. And so that's exactly what this methodology is designed to avoid, which would be the issue that, that if we were just looking at rates, then you wouldn't see that.
Karen, I just wanted to make one point on a comment that you had on that matrix to add additional rows. When I was HUD CFO, very focused on the budgetary consequences of policy reforms. So I had elbowed Paul and just said, we need a row on taxpayer risk, right? That matters quite a bit. So, yeah.
Yeah, I was just gonna follow up on that point real quick. Sort of in the sort of macro financial thing, I think, you know, Ed, one thing to kind of keep in mind here if we're going to talk about, you know, efficiency issues, I think we're sort of thinking about this solely in partial equilibrium. I think you need to keep in the back of your mind some of the general equilibrium effects of sort of subsidizing this market vis-a-vis others. But I think another important part of this is the endogeneity of the fragility of our system with our strong desire to have a lot of leverage in the system. And I think people lose sight of that. I mean, if you've got 25% of mortgages coming in with, you know, less than 5% down, you know, if there are shocks, it's going to increase the likelihood of there being problems.
Yeah.
In your paper, you sort of, it seemed at least in the presentation, you were setting this up as a choice between those methods. But once you saw your, you know, spider chart, you know, different methods or different approaches dominate, you know, different things. Wouldn't it make sense to just say what blend of solutions should we have in our system? We already have all of those anyway. And should we just try and optimize each of those? Because I guess my view, maybe getting to the summary, is the reason we've had trouble with GSE reform is that people wanted to start from scratch, get rid of one of those systems, and somehow think that they were going to find a better system to replace that. But you know, your chart pretty much shows there is no dominating system.
Yeah, that's a great point. You know, how, you know, can you get all, you know, sort of a mega system that gives you all the choices, private label, you can have a portfolio, you can have insurance. We did not think about that. You know, what often happens, and you know this, is, this goes a little bit to Scott's comment, we put a lot of subsidy, we choose one system and we put all the subsidies into that. It's very hard to, you know, balance the subsidies across those different models to make them all equally viable so that you get the best of all possible worlds. But it's a good point.
Okay, great. Hey, with that, I think more or less we're still on time. We're going to take a break and reconvene at 3:30. Thank you.